ARCC Capital Corporation and Main Street Capital are among the best business development companies of all time due to their very impressive track records delivering market-crushing total returns ever since they were publicly traded several years ago. However, there have been some recent developments that indicate that both of these companies may deliver underwhelming total returns moving forward, and in this video, we'll discuss why. Hey everyone, this is Samuel. I run High Yield Investor, the top-ranked investing group on Seeking Alpha, and I specialize in dividend investing. I recently started my YouTube channel in order to share my unique approach to dividend investing with a larger audience, and I need your help to make it a success. So if you could please like this video, subscribe to my channel, and even share something in the comment section below about what you think about either ARCC Capital Corporation or Main Street Capital or even the broader BDC sector, I'd be greatly appreciative. Thank you very much. So what makes ARCC Capital Corporation and Main Street Capital so successful as a business development company? Well, first of all, they have very strong underwriting platforms that have delivered alpha for them over the course of many decades. In the case of ARCC Capital Corp, it's due to the fact that they are supported by ARCC Management, which is one of the largest credit platforms among alternative asset managers in the world, with scores of employees that specialize in underwriting middle market deals, to the fact that they also have a really good workout team and also superior deal flow. ARCC Capital Corporation gets the benefit from these economies of scale. Meanwhile, for Main Street Capital, what sets them apart is that they're internally managed. And what this means is that insiders own a substantial portion of the stock, aligning them very closely with shareholders. And also, they get economies of scale, which means that as the BDC gets larger, their expense ratio of paying the management goes down. Whereas ARCC Capital Corporation is an externally managed BDC, and the vast majority of BDCs are externally managed, they generally charge a fixed fee on a percentage basis of assets under management, which means that their management fee tends to remain fairly high regardless of how big the BDC gets. Whereas with Main Street Capital, the larger they get, generally the lower their management fee gets because they're internally managed, and so economies of scale work really well for them. This has enabled them to achieve much higher returns on investment over time relative to some of their peers. And a second benefit of this is that as a result of that lower cost structure, combined with Main Street Capital's very effective underwriting skill over the years, they now have a very, very substantial premium to their net asset value and their stock price. And what this means is that the management can then issue new shares on a regular basis, and that is accretive. It increases their book value or their net asset value per share with each share issuance. That increases the value, the intrinsic value of the investment for existing shareholders, and also enables management to reinvest those proceeds on a basis that increases earnings per share and ultimately dividends per share. This establishes a virtuous cycle because the more that the company grows their NAV per share, their dividend per share, their earnings per share, the more that investors want to own the stock, which drives up the premium even further, which in turn enables them to issue new shares at an even more accretive level, and the cycle continues and continues. Meanwhile, ARCC Capital Corporation, they are externally managed, so they don't get quite the same benefit. They don't get quite the same premium from the market, but they still have such an impressive underwriting track record. And they also have such a good track record of creating value over the long term for shareholders that they now also enjoy a premium to NAV. And so as a result, management is able to also opportunistically issue shares. And throughout their history, whenever they've traded at a premium, management has been really good at issuing shares at a pretty good premium to NAV and then recycling that capital into accretive opportunities to consistently grow the book value, or at least sustain the book value, while also growing the net investment income and the dividend per share over time. And so these are the factors that have driven such strong long-term total return outperformance for both of these business development companies. Another reason they both have been able to weather so many storms over the years, whether it be the great financial crisis or the COVID-19 crash. Through COVID-19, neither of them cut their dividends, while many of their peers had to slash their dividends, and they both bounced back quite strongly from that event. And the reason for that, in part, is because they both have investment-grade balance sheets. By having that strong underwriting, by having that reasonable amount of leverage, by having that access to capital at a reasonable cost and maintaining good liquidity, they're able to support their dividends through storms. They're able to support their investment portfolios through storms, whereas many other peers have had to slash their dividends. That's another big key. Another reason why they've been so successful and they are still in good shape today is because they have not only paid out a good dividend, but they've sustained their dividend and grown it over time, whereas many other BDCs have had to slash their dividends. And this is especially impressive in the BDC sector because by law, they're required to pay out at least 90% of their taxable income. And given that almost all their income comes from loans, that's all taxable income pretty much that comes back to them. So they have to pay out pretty much all of their income, 90% plus of it, in dividends in order to maintain their BDC rating. But they've been able to do this very effectively over time, again, partly due to the accretive issuances that they do, but also because they've been very creative in managing their payouts so that they're able to build up extra income on the balance sheet over time and not overextend themselves. and instead have favored a more special dividend policy where they'll have a baseline dividend that's significantly below that 90% threshold. But then whenever, depending on the year, they'll pay out large special dividends to still meet that threshold to maintain their BDC status while still protecting their baseline dividend. And because they know that if they had to slash their dividend, the market would penalize them significantly. And so they've been able to maintain that steady dividend payout over time. And finally, of course, another major driver, as it is with all BDCs for total returns, due to their high payout ratios, they both pay very attractive dividends. ARCC Capital Corporation pursues a more aggressive dividend payout policy as they have a 9%, actually over 9% dividend yield at present. Meanwhile, Main Street Capital has a roughly 6% dividend yield, but again, they pursue a more aggressive growth strategy, and they also do trade at a much higher premium to NAV, so their yield is going to be a little bit lower because they're a little bit more expensive. But both of them do offer very attractive total returns with dividend yields of 6%, 9%. You don't really have to generate a ton of growth in order to get to that double-digit annualized total return that they seek and that they have offered for so many years. And so, as you can see, they have a lot going for them. That being said, there's some reasons to be concerned right now. First reason is that simply that there's a lot of growing competition in the space. Private lending, direct lending has really grown in popularity in recent years, especially after the banking crisis with Silicon Valley a couple of years ago, where a lot of banks have had to pull back from their lending and BDCs have stepped in to fill that void. As a result, you have the likes of BlackRock, you have the likes of Blackstone, Brookfield, Blue Owl, JP Morgan, Goldman Sachs, KKR. Of course, Ares is stepping up even more, and many others who are pouring into this space. Hundreds of billions of dollars are coming into this space, and as a result, the supply-demand dynamic is becoming less favorable for these middle market lenders because you have many more people willing to lend money and a relatively fixed number of borrowers. Even if that number is growing some, it's being dwarfed by the growth in the supply of loans. And so as a result, the terms that these lenders are able to get, whether it be the yield or whatever kind of securities that they get on the covenants on the loans, are much less attractive than they would be otherwise. And so that reduces the risk-reward profile for these lenders. Another reason to be concerned about their forward return outlook is that they're going to be losing one of their biggest earnings growth tailwinds of the past few years, namely interest rate hikes. Both of them are weighted heavily towards floating rate loans that benefit from interest rate hikes. And as you probably know, the Federal Reserve has raised interest rates very aggressively ever since the beginning of 2022. That tailwind is largely off the table now as the consensus is that the Fed is largely done hiking and their next move is more likely to be a cut than a hike. And as a result, with the lack of future cuts, they're not going to get that rising yield on their investments that they had previously. A third reason to be concerned about their total return outlook going forward is simply that the economy is weakening. You have unemployment that has risen steadily over the past year or so and now is around 4%. You have consumer spending and sentiment that's also weakening as the large COVID-era savings surplus has now been spent down completely and is actually in the negative from where it was then. Saving rates are low. Consumer debt is at highs. You have delinquencies rising across the economy. And so as a result, it seems that consumer spending, which has been the fuel that has driven the U.S. economic strength over the past few years, is largely weakening. So that's another reason to be concerned. In fact, you have ARCC Capital Corporation CEO on a couple of earnings calls ago saying that he fully expects delinquencies and defaults to rise this year in the BDC sector. You also find a growing weakness in the lower portion of most BDCs, including ARCC Capital Corporation's portfolio, where there are some of their borrowers that are beginning to pay down or beginning to run out of liquidity on their credit lines. And as a result, they may have to start going on non-accrual or even defaulting on some of their loans. And so these are all concerns that you can see in this sector. And in fact, one of the misrepresentations often about looking at the headline numbers for BDCs is that, again, they're primarily lenders. And so it's kind of a binary thing, right? They're either the loans are currently being paid off. It doesn't matter how well the company's doing. Are they meeting their obligations? Everything is great. But then there's a certain discrete point at which they're no longer meeting those obligations. And when that happens, they go on non-accrual, they go on default, and you look at the very least, interest is getting lost or potentially even principal for the lender. And so right now we're in that transition period where things are going from really strong for their underwriting or for their counterparties to now starting to be a little bit weaker and a little bit weaker and a little bit weaker. And so eventually you're going to see a whole bunch of these, potentially a lot of them, depending on what happens to the economy, moving on to non-accrual and even default in many BDCs. That's where underwriting skill is so important. I do think ARCC Capital Corporation and Main Street Capital are better than many, but even they will not be fully immune to this if it really comes to fruition. So it's another thing to keep an eye on. And the fourth reason why I'm a little bit concerned about the forward return outlooks for these two stocks in particular is that both of them trade at quite lofty valuations relative to their own history. Traditionally, ARCC Capital Corporation is traded around 1x its net asset value. And as I said previously, it's done a great job. Whenever it's moved up above on a price to NAV basis above 1, it'll issue equity and grow. When it's below, it hasn't. It's been very disciplined about that. But it's well above 1 now, which means that it's very unlikely, in my view, to see any kind of further multiple expansion moving forward. In fact, it's more likely to see multiple contraction, and that will weigh on total returns. So when combined with the fact that I expect the earnings growth to slow considerably due to the lack of interest rate hikes, in fact, as interest rates are cut, it will weaken their earnings. And so when you combine that with their lofty valuation multiple, that will likely compress back down towards 1 or even lower in the future. Yeah, I mean, their dividend yield of 9.2% is pretty good. But when you have a headwind to that, it's likely going to be only in the mid-single digits at best moving forward. And that's assuming no major pullback in the sector. Main Street Capital, okay, they trade at like a 1.6 or something like that times premium to NAV. It's very, very high, well above where they've traded historically. I don't see that as being sustainable, certainly not moving much higher. And so again, they could potentially see a very large drawdown in their valuation multiple, which poses a severe headwind. Yes, their growth is going to be a little bit more robust than ARCC Capital Corporation's due to the fact that they have a substantial equity investment portfolio and they're retaining a little bit more capital that they can reinvest and drive that growth, as well as the fact that they can still issue shares at a very accretive basis to drive growth. But still, with their growth is going to slow due to the interest rate headwind as well as economic headwinds and the lack of ability to issue new equity at quite accretive rates if the stock price dries up or declines, and the fact that they're going to probably face even more stiff valuation multiple headwinds than ARCC Capital Corporation, and the fact that they only have a 6% dividend yield, which gives them less of an initial total return to begin with. They're looking at a similar scenario, even worse than ARCC Capital Corporation in terms of total returns. So again, ARCC Capital Corporation and Main Street Capital, terrific track records, strong underlying fundamentals right now, solid dividend yields that should be safe for the foreseeable future. So if all you care about is, just getting that nice dividend yield with maybe some growth over the long term, and maybe you already have a very low cost basis in the stock and you don't want to lock in large capital gains and you just want to buy and hold and not worry about it, fine. I don't think there's anything to be worried about too much here. However, if you're invested in these, as I would be, for total returns, I would steer clear of these stocks right now because, as I've mentioned, they face numerous headwinds and some of their biggest tailwinds recently are going away. And as a result, I don't think the total returns for either of these stocks are going to be all that impressive over the next several years, potentially even negative depending on what happens to the stock market. If you enjoyed this video and found it to be informative and helpful for your own dividend investing, please give it a like. Please let me know in the comments below what you appreciated or what you'd like to be better about it, or if you have a request for a different type of video in the future. And then make sure you subscribe to my channel. It would really help me out a lot. Thank you very much. See you next time.